It's Brian Preston, the money guy.
Let's transition and let's talk about 50-year-olds. Celebration or panic? So this is really, you're going to take, at this point, we're going to measure your emotional temperature.
Okay.
And when I'm talking about this is when, if you've been well prepared, you're vision planning, you're thinking about what you want to do, you want to stress test the plan, you want to, save like your life depends upon if you're behind.
Yeah, I think that was interesting. In pre-show prep, we're like, a lot of folks ask, oh, well, I'm in my 50s, and I wish I would have heard you guys when I was in my 20s and 30s, but I didn't. So what do I do now? Well, the unfortunate truth is you got to work hard. You have to work exponentially harder in your 50s if you're behind than you would have in your 20s. That's okay, though. It's still possible, but you have to check yourself and go into it knowing I've got to make up some time, or I do need to move that goalpost. Maybe 65 isn't my exit point. Maybe it's 67 or 70 or something along those lines.
And I also think this is a part where you've got to balance the risk versus reward. A lot of people, I think you're so used to being, a person that's growing, maximizing, I'm accumulating, I'm building. But when you are in your 50s, you also, you don't want to run up the score and take on more risk to where you run the potential. It's not just risk tolerance, just because you can handle it. It's also risk capacity. Could you recover if you really blew things up? That's what you need to be very careful of.
And then you need to be reticent of the fact is this the time I need to get with a professional, right? If I'm landing this plane, do I know that my landing gear works? Do I know that all my instrument panels are working? Do I know that I can actually have a safe, smooth landing into retirement? This is a great time to start talking to an advisor to see if there are some advanced planning ideas you may ought to begin investigating.
Well, let's talk about the financial planning pyramid.
Sure.
So the first thing, cash flow. What you're thinking about here is adult children. Look, we unfortunately, it's gotten to the point you love these kiddos, but they're not leaving the nest. They're not leaving the nest, so you are giving them economic outpatient care. Your goal with cash flow is to try to get those kids off of your payroll ASAP once they're out of the house.
The other thing that we see in the 50s is this probably is that decade where you're completely debt-free. You don't owe anybody anything, no debt, probably including your mortgage. This might be when it falls off. What a great place to be. We think that you're not really financially independent unless you are completely debt-free, and I think for a lot of folks that happens, or the ability to make that happens, is in this 50-year-old decade.
From a risk management standpoint, this is when maybe you want to look at long-term care insurance. Now, look, I'm not the biggest fan of this thing because I do think it's kind of it's not like it's changed a little bit. You used to say we had this donut hole method where if you were under $1 million, you didn't really need long-term care as much because you had a big safety net with, between Medicaid funding, Medicare, and all the other things. The assets, yes, it's a decent chunk of money, but it's just not enough to pay the heavy premiums because it's expensive to do long-term care. People over $3 million in assets, you probably are getting into that threshold of that you might be able to self-insure. You have enough assets that you can cover whatever's coming your way. It's that 1 to 3 is really the sweet spot that they want to make sure they create a plan or buy protection coverage that those assets might have something that backstops them.
But if you are thinking about maybe I'm going to pick up this premium for long-term care insurance, it might be okay to let other types of insurance fall off. Perhaps you bought that 20-year policy when you were 30 or 35 years old and you've been saving and you're at the doorstep of financial independence. Maybe you don't need life insurance anymore. Maybe you can let that fall off, and that's going to be one less expense that you're going to take into this next stage of life with you.
Yeah, I think clients, because you bought a 20-year level term when you were in your 30s and now you're in your mid-50s. You're like, do I go get more insurance? I'm like, if you're financially independent, it's okay if it goes away after that 20-year period is and that lower premium disappears.
From an investing standpoint, the 50 decade is really when you want to make sure that your retirement runway plan is sound. It's not, oh, okay, I just want to save $1 million because somebody told me $1 million is what I need to retire. No, you actually tested it. You know that you're going to be able to land this plane, and no matter what the world throws at you, your retirement, your financial independence plan is intact.
And this is an echo. This is probably, you said this earlier, a time to consider going pro. This you don't know what you don't know, so you might want somebody that's going to help you out, with how you're handling your assets and stress testing it. And that leads to also, it is diversification, asset location. These are all benefits also a good financial planner can help you out with. And then I've mentioned already also risk, reward. Are you taking too much? This is the time to kind of figure out what that balance and where it relates to you.
Yeah, we see 50-year-olds, 55-year-olds, 58-year-olds all the time that come in. And they've been so successful investing. They built this great portfolio because they were so used to having a 90-10 portfolio. And while they may feel comfortable with that and they may have the risk tolerance that they can sleep at night no matter what the market does, if they're retiring in the next 3, 4, or 5 years, their portfolio might not have the capacity for that to take place in the world's worst downturn. So just make sure you understand the difference in risk tolerance and risk capacity.
Tax planning, Bo.
Okay.
Roth conversions are powerful here, especially
Absolutely.
for early retirees. The other thing I think is you got to pay attention to some huge key dates. These are something, when you're in your 20s, 30s, these things look in the distance, and then one day you wake up and you're here. But these are powerful dates. When you turn 50, and it's just the year you turn 50. So if you're 49, this also pertains to you. If you know you're turning 50 in the calendar year, you get to do what's called catch-up contributions, both on your IRAs, on your 401ks or employer plans. Pay attention to those extra thousands of dollars that you can save for yourself.
Yep. At 55 is another pretty important date that happens in your 50s because, as you know, most IRAs, most retirement plans have a 59.5 date before you can start pulling it out. Well, if you're employed with your company and participate in their 401k on the day that you turn 55, and then you retire, you can actually begin drawing distributions out of your 401k before 59.5. So 55 is a pretty important date. It also is going to affect whether it makes sense for you to roll assets into an IRA or if you want to stay participating in your employer or former employer's 401k plan.
That's exactly right. So if you are retiring early, be careful before you just automatically open up that rollover IRA. There's definitely some choices there. 59.5. We all know that's the age that you can get access to your retirement assets without doing some crazy advanced strategy where you annualize, by turning it into an annuitizing it. You can do this at 59.5. You get access to your retirement accounts without the early payment penalty. So pay attention to that. That's a key date that you do want to know when that is for you. Transitioning into estate planning.
Yeah, so one of the things you have to think about is as you get into your 50s, you're kind of sort of thinking about what does life after me look like? What are the ways I need to structure? So this is potentially where I need to think about titling my assets differently. Maybe I need to have trust set up. Maybe I need to have trust language in my estate documents. You just want to make sure, like every other phase and stage of life, that your estate plan matches where you are in your financial journey, where your family is in their financial journey, and ultimately what your wishes are long-term for your assets, both while you're here and then also after you're gone.
And also make sure that your wills and your estate plan with what's drafted by the attorney ties in and works well with the IRA beneficiaries, your life insurance beneficiaries. Those things all need to be all on the same sheet music because, by the way, to the government, they are treated a lot different, because assets that are going through probate and your will are treated one way. Beneficiary designations are a completely different thing. They need to be coordinated so you don't have any oopsies when you have such a lot of your assets and your legacy riding on this.
So, okay, let's look at some hard numbers in your 50. If you're a 50-year-old that's not started saving at all, it's a little daunting to get to $1 million by 65. You got to save $2,500 a month. If you wait till 55, you got to save about $5,000 a month. But if you've been saving or if you've been building assets, and you've got $350,000 saved by the time that you reach 50, and you can make about 7% on average until 65, you're on track to be a millionaire. For a 55-year-old, if you have $523,000 saved, that will turn into $1 million over the next decade. Still pretty powerful.
Before you pull up the Financial Mutant stuff, I think it's so powerful to share that just a 10-year runway, half of your money still is going to come from your army of dollar bills.
Right.
So guys, it's not a bad time to start saving. You can make this happen. And for my financial mutants who are kind of getting a start on this, a 50-year-old who wants to have $2 million at retirement at 65, right under $5,000 a month.
I know that's big.
Yeah, you got to have a really big shovel, but you're in catch-up mode. 55-year-old, $9,932 a month. For a 50-year-old who wants to know what the lump sum needs to be to have $2 million at retirement at 65, it's $702,000. 55-year-old, it's a little over $1 million. right at $1,045,000 to reach $2 million by the time you reach 65 years.
Still
of age.
incredible that those dollars have some juice. Remember, it's not like at 65 your money stops getting invested. It's still going to keep growing past there. It's just amazing. If you have the time, your dollars can do some pretty amazing things.